If you passively invested into the stock market every single day, what would happen? That's what I wanted to find out. The first thing I needed to do was decide where I would invest my money, and after careful consideration, I managed to narrow it down to a single investment. Before I explain, no investments I talk about in this video are recommendations, nothing I say should be taken as financial advice, and your capital is always at risk when investing. Now, investing is for the long term, and 1 year really isn't anywhere close enough to judge how viable it is. But I wanted to do this anyway, just for a bit of fun. So I knew that for my goal of a well-diversified passive investment, an index fund was the way to go. A lot of people like to invest into the S&P 500, which provides exposure to the 500 biggest companies in the US, but instead I opted for even more diversification through a global index fund. So I went with Vanguard's FTSE All-World ETF, as this would spread my money out across thousands of businesses in all kinds of different industries based all over the globe. That might be helpful if, I don't know, Trump crashed the global stock market in the middle of this experiment. Yeah. Anyway, I also decided to track the progress of Vanguard's S&P 500 ETF as well, so I could see which fund would have performed better over the course of the year. Would I make any money, or would I lose money? Let's find out. As expected with a long-term experiment and not much money in the market, month 1 was a slow start. But that doesn't mean that there were no signs of movement. Things actually got off to a flyer, as after just 4 days our portfolio's value was up over 1%. That means we'd made a profit of, wait for it, 43p.
Wow!
But I wasn't cashing out and retiring just yet, I wanted more. But it seems we had a few signs of potential issues facing us already.
And our top stories, Asian stocks sink led by Japan as fears of a deeper US economic slowdown rattle traders around the world.
Traders may want to put on their hard hats. That's because US markets picked up where Japan left off, and the global stock market intensifies as the sell-off continues.
In early September 2024, the value of our portfolio took a bit of a nosedive due to rumours of a potential US recession on the horizon. Our returns suffered, falling all the way down to minus 2.23% on the 6th of September. But seeing as this was all caused due to uncertainty, things eventually settled down and our investment crawled back up into the positive just before the end of the month. After 1 full month of investing, we'd invested £230 and made a return of £231 and 1p so far. However, seeing how volatile the market was in just the first month, it was certainly going to be anything but smooth sailing. And if you're wondering how £230 can possibly be a full month, the markets aren't open on weekends or bank holidays. With a bit of a rollercoaster start behind us, waters started to look a little less choppy. In early September, central banks started to cut interest rates and even hinted that there will be further cuts in the future. On top of that, bond yields also dropped in line with the interest rates, potentially causing more people to sell off and put their money into the stock market instead. Our investments started to grow pretty consistently, rising all the way up from a 0.44% return to 6.2% on the 25th of November. If this level of growth were to continue, we'd be looking at massive returns for the year. Far more than the average annual returns of the FTSE All-World Index. I'm not going to lie, things look great. After investing a total of £740 so far, we'd earned £45 and 88p in returns. And the only question we had was whether this could continue. Now, I wasn't expecting persistent growth throughout, as there will always be ups and downs in the market, but at this point, we had strong headwinds guiding us to shore, and the ship seemed to be chugging along nicely. Coming off of a great couple of months towards the end of 2024, December brought us back down to earth a bit. The lofty heights of our potential returns, should things continue the way they were, now seemed like a far cry from reality. As the new year drew closer, we'd slowly lost around half of the returns we'd built up in the first few months of investing, falling from 6.2% down to 3.19%. With a worrying end to 2024 behind us, we headed into 2025, not knowing what was in store for us next.
Now coming into 2025, following the best back-to-back yearly gains since the late 1990s.
Many experts expect the new year to bring interest rate cuts and a further easing of inflation.
2025 started off with a bang, and by the 17th of January, our returns increased to 7.19%, the highest we'd seen up to this point. But unfortunately, this growth wouldn't continue for long, as we hit a big plateau over the next few months. This stagnation wasn't ideal, but little did we know at this point that bobbing up and down on the spot would seem like a luxury compared to what was waiting for us ahead. For some time now, murmurs of a potential trade war had been lingering, and even talks of a stock market crash being on the horizon. We were so innocent, minding our own business on the calm ocean waves, while a huge storm brewed in the distance. The 20th of February 2025. The day the market started to react to the news of a potential trade war. The US had started to dish out global import tariffs like sweets on Halloween, growth was non-existent, and progress started to melt away. The world had taken a match and set our 6% return to date on fire. 6 months of investing had got us to this point, and in just 9 trading days, the entirety of our returns were wiped out, all the way down back to break even. And this was only the beginning. We braced ourselves for the storm, not knowing the true extent of just how bad things would get. I'm not going to sugarcoat it, the following week was a hard watch, as we were 1.28% down on the 7th of March, and then dropped down again to minus 3.37% a week later. US tariffs had now been imposed on Canada, Mexico and China, with rumours of European tariffs on the way as well. Investors started to move their money into typically safer investments like bonds instead of the stock market, and it seemed like things could only get worse. But how much worse could they get?
We're coming on the air with breaking news about the economy and another brutal day on Wall Street.
Today, Wall Street experienced the worst day since 2020.
More than $6.5 trillion in U.S. stocks wiped out in just the past 2 days. That's after President.
The next 8 trading days hit us like that horrible feeling you get when you realise that you're not young anymore, and you never will be again. Your friends have all grown up and left you behind, had families, got great jobs, and they're all doing really well without you. They still see each other, but not you. You're all alone. You're sat there investing £10 a day for a YouTube video. No wonder everyone left you, you sad, pathetic. Every £10 investment we made between late March and early April seemed to be washed away almost immediately as the numbers started to plummet. A trade war had well and truly begun. The US upped the tariffs, and China responded, and new levies and restrictions were causing markets to sell off, and sell off fast. The 7th of April 2025 saw a new low for our investment, and things had started to get nasty. We were now down by an eye-watering 11.97%, and with the air of uncertainty still lingering, things didn't look like they were set to improve. We only had 4 months left to go. What would even happen to our investment at this point if the market started to recover? In what seemed like a desperately low point for the market and our investment, we were handed a small lifeline. The initial reaction to the trade war and ongoing tariffs caused worldwide panic, but then a brief moment of calm. Things didn't exactly bounce back, but they mellowed and even began to recover a little, and we even saw a couple of days in particular producing huge returns. Somehow, we found ourselves down by 4.69% as April came to a close, which wasn't nice, but better than where we were before. May looked like the turning point to our recovery, and as we trickled into mid-June, the numbers were actually looking loads healthier. That's the benefit of pound or dollar cost averaging. When the market crashes, we're still investing at all the cheaper points.
First up, U.S. stock futures. Little change today as the S&P 500 trades just within points of its all-time high.
U.S. inflation comes in lighter than forecast for the 3rd straight month.
Seeing as we'd invested a good chunk of money over the days where the market was at its lowest, we were able to see an immediate benefit as it recovered. And that's why long-term investing is so important. It's always a marathon, not a sprint. We'd built back up to a solid return of nearly 2% by the 24th of June, and if we could sustain profitability from this point on, that would be an achievement in itself. But little did we know that we wouldn't even have to settle for slow growth for long. Good news kept coming left, right and centre.
Israel has confirmed it has agreed to a ceasefire with Iran.
Another record. Global equity hits a new high as the EU and US progress towards a trade deal.
The 28th of July marked a big day for us. Despite the huge drops we'd faced, we hit our highest percentage returns since we started investing. With less than a month to go, surely we'd be ending the year in profit. We couldn't get too ahead of ourselves though. Not after our returns have been ripped away so suddenly in the past. But the average yearly return of the FTSE All-World Index is around 9% over the last 20 years, and as our investment continued to grow, we actually looked set to hit that figure. With July drawing to a close, we were up 8.12% overall. That's almost £200 in profit. There were 2 weeks left. Surely nothing can go wrong. Can it?
It can.
Plus, the massive drop for copper after the White House announced a 50% tariff on semi-finished copper products.
We get China PMIs this hour set to show early trade war damage to the economy, with the factory gauges expected to slip back into contraction.
We dropped down 2% overnight. We surely couldn't do this again. Not now. Thankfully though, the worst had already been and gone, and the market wasn't so quick to implode as it did before. And over the next 2 trading weeks, we made steady progress once again. As we sailed into the 13th of August 2025, we had officially invested £10 every day for an entire year. And here were the final results. In total, we invested £2,540. Again, due to the fact that we could only invest on the days that the market was open. By the end of the year, our investment was worth £2,728 and 2p, a total return of just over £188. The final return percentage sat at 7.4%, which isn't quite what it's been averaging long term, but when you look at all the highs and lows we had over the past year, 7.4% is a great return. One question still lingered though. How different would things have been if we'd invested into the S&P 500 instead of the FTSE All-World Index? Well, if we'd invested the exact same amount in the same £10 daily increments, Vanguard's S&P 500 ETF would have returned us a little over £160, with a total portfolio value of £2,701 and 38p, or a 6.35% return. In no way are we saying that this makes one fund a better choice than the other, and this is not financial advice, but due to the very US-centric problems that happened over the year, we benefited from having that additional diversification on our side, even if the FTSE All-World Index is still very heavily weighted towards the US itself. If this experiment proves one thing though, it's that investing should always be for the long term. We saw highs and lows, big swings, and even a market crash where many investors would be running to withdraw our money. And here's a crazy fact for you. If we'd cashed everything out after the Trump-fueled crash in April and reinvested it all back exactly 1 month later, we'd have made a loss of 1.69%.